I'm putting a clock on it. Here comes financial Armageddon. We're on day one. Why are we on day one? Because it's the first day reporting the story. Okay. No, it's not in reality, but since this is the first time we're telling you about it, I'm calling it day one. We'll keep track going forward. Here's what I have to say. Tick-tock, tick-tock. Now, look, I've said it before. You know, the size of the derivatives market is hilarious. There's different reports on it, but the last one says that it is $639 trillion. That number is so large, it's comical, right? I believe it's 10 times the size of the entire world economy. Okay, it's also called a swaps market. So there's this giant swaps market where they're taking insane risk with our money. And now, Dodd-Frank bill was supposed to regulate that. And I mean, it did this much regulation, a scintilla of regulation, but the banks say, oh, you know what? It's okay. We don't even have to follow that scintilla of regulation. Why? Oh, did we call this a swaps market? We meant futures market. That's not part of your regulation at all. So futures, yes, that's what it is. So let me begin to explain that trick to you. Eleazar David Melendez explains futures traders are required to set aside less collateral on their trades, an incentive to place larger bets. So do you understand that? They're moving to the futures market because they can put down less collateral and make larger bets. Now, if you put down less money and you make bigger bets, guess what happens? Because if you make a tiny little error, you don't have the money to back it up. That's how we got into the mess in 2008. They're putting that on steroids. This is going to be awesome. Under the new regulatory regime, all but a few of the so-called block trades must be disclosed to other market participants, enabling regulators to monitor the scope of the regulation. Now, this is what they're trying to get rid of. So they're saying, now, even those tiny little trades will not be monitored. Oh, great. That won't cause trouble at all either. Continuing. By contrast, which future trades must be disclosed and which can be kept private are generally left to be determined by the private companies that operate the exchanges. Good night, Irene. Don't worry, the banks will regulate themselves, and those exchanges that get all of their money from those banks, well, I'm sure will be very tough in regulating them. In other words, good night, Irene, there ain't going to be no regulation, okay? So, furthermore, under Dodd-Frank, losses on swaps trades are limited to parties that engage in that trade. But in the futures market, the consequences of an ill-fated bet can spill out to myriad players, from the brokers who engineer the positions to the clearinghouses that execute the trades. You understand that part? So before, if party A and party B do a deal, it goes bad and one of them gets screwed real bad. Now it's broader, so more banks suffer because of that trade. The clearinghouses suffer because of that trade. So when there is an explosion, it knocks more people out, and then those knock more people out, and then financial Armageddon. I'm not playing, and I'm not overstating it. Remember, it's a $639 trillion market. Okay, continuing. James Cawley, CEO of Javelin Capital Markets, so it's not just us. This guy says, quote, as the market gravitates to cheaper platform, and it's cheaper because it's unsafe, that creates risk for everyone. So here's the CEO of a guy who's running a company in this field saying, don't do it. Don't do it. It's a really bad idea, and it's going to blow up on all of us. They're like, yeah, step aside, step aside. All right, here's one more. George Harrington from Bloomberg. A margining regime that favors financial futures over financial swaps runs the risk of increasing systemic risk. By systemic risk, they mean risk that applies to the entire system. One thing goes down, it's a bunch of dominoes, and they all go down. Here are people inside Bloomberg, inside Javelin Capital Markets saying, don't do it! The swaps market was a disaster to begin with. That caused the 2008 crash. Now we're going to get something even riskier that affects even a bigger portion of the markets. Tick, 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 tick. And let me tell you guys who's going to bring this disaster to you. It's a group called the CME Group. Why are they so important? They're setting up the exchanges where they do not regulate the banks, and they get to do all this trading, And this is where it's going to blow up. Now, you can look back later after it blows up to this video. Don't listen to any of the other nonsense. Actually, the right wing will blame it on the government later. They'll blame it on this. They'll blame it on that. I'm telling you ahead of time. It's going to happen, and it's going to happen at the CME Group. What do they run? They run the Chicago Mercantile Exchange and the Intercontinental Exchange, which is probably the riskiest place on earth. Anything that comes out of the Intercontinental Exchange, watch out, okay? And by the way, here's something fun. They're about to buy the New York Stock Exchange. So if you think things were risky before, wait till you get a load of them afterwards. Tick, 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 tick. We're on day one. I don't know when it'll blow up. I don't know if it'll be 2 months, 2 years. I don't know how long they can keep it together with duct tape, but I guarantee you this. If you take this amount of risk with this amount of money, it will bring down the entire global financial system. That sounds harsh, but it isn't. They're all connected. There's no way around it. It's a pure matter of logic. All right, you have that to look forward to.